If you've been in the crypto space for any length of time, you've probably heard the comparison. Crypto is the next wave of fintech. On the surface, that sounds flattering, like we're advancing financial technology, taking it to the next level. But here's the problem. Crypto is not fintech, and more importantly, it never should be. Today I want to explain why lumping crypto in with fintech totally misses the point of what this movement is about. Because once you start treating crypto like fintech, you end up recreating the very same systems it was meant to replace. So let's start with what fintech actually is. It's short for financial technology, and it refers to software that improves how traditional financial services operate. It includes things like mobile banking apps, digital wallets like PayPal or Venmo, robo-advisors, neobanks, and buy now, pay later platforms. All of these tools make it easier to interact with legacy financial infrastructure, but none of them change who controls it. That's the key difference. Fintech is built on top of the existing system. It still depends on central banks, commercial banks, payment processors, credit bureaus, and financial regulators. Fintech might give you a slick user interface and faster transactions, but underneath the hood, you're still playing by the same rules. Crypto, on the other hand, was born out of a completely different philosophy. It wasn't created to work within the system, it was created as an escape hatch from it. When Bitcoin launched in 2009, it wasn't trying to become the next PayPal. It was a reaction to the failure of traditional finance. The financial crisis, the bailouts, the overreach of central banks. It was a wake-up call. And crypto was the response, a peer-to-peer, decentralized system of money that didn't rely on trust in any institution. Mwah, chef's kiss. That's why Bitcoin is so different from any fintech app. There's no CEO, no headquarters, no hotline to call if you lose your password, unfortunately. It runs on a global network of volunteers, secured by code, consensus, and cryptographic proof. It's open source and permissionless. Anyone can use it, and no one can stop it. Ethereum expanded on that idea, giving us smart contracts and programmable money. But the core principle remained: disintermediation, removing the middlemen, creating systems that are trust minimized, transparent, and resistant to censorship. Now here's where things get messy. Over the last few years, we've seen a wave of crypto projects chasing legitimacy. They want to attract institutional capital, comply with regulators, and go mainstream. And while some of that is understandable, it's also led to a dangerous trend, turning crypto into fintech. Let's look at the rise of custodial solutions. Centralized exchanges like Coinbase and Binance are great for onboarding new users and for actually trading cryptocurrencies, but they hold your keys. That means they control your assets. And if regulators pressure them or they suffer a security breach, your funds are at risk. We've seen this happen with platforms like Celsius, BlockFi, Voyager, and most famously FTX, but there's been many more before those. These platforms weren't crypto in spirit. They were fintech in disguise, opaque, custodial, and centralized. We've also seen this with ETFs and other crypto derivatives. Yes, they offer exposure to the asset class, but they don't contribute to the network. Buying a Bitcoin ETF doesn't support miners or validators. It doesn't require a wallet. It doesn't teach users about sovereignty. All it does is give Wall Street another product to sell. And then there's the regulatory side. Fintech companies thrive on regulatory compliance. They build within the constraints of the law and work closely with governments and financial institutions. But crypto was never meant to operate within those constraints. In fact, its greatest value comes when it offers a way out. Think about people living under authoritarian regimes. Think about those dealing with hyperinflation, capital controls, or financial surveillance. For them, crypto is not just a more efficient payment method, it's a lifeline, a way to exit a broken system. That's why it's so important to preserve the core values of crypto: decentralization, censorship resistance, self-custody, and financial sovereignty. But when we blur the line between crypto and fintech, we risk losing those values. We risk creating a future where crypto exists, but only in a sanitized, permissioned, surveilled form, one where you still need to ask a company for access, where you can be debanked with a click, where the same institutions that caused the last financial crisis are now the gatekeepers of the new one. That's not the future that I signed up for. So how do we push back? Well, first, we support real crypto infrastructure. That means open source wallets, decentralized exchanges, non-custodial services, and privacy tools. These are the projects that uphold the ethos of the space, even if they're less polished, less user-friendly, and not publicly traded. Second, like we're doing with this channel, we educate users. People need to understand the difference between owning Bitcoin and owning exposure to Bitcoin, between holding Ethereum in a MetaMask wallet and having it sit on Robinhood. That education empowers people to make better choices, not just for their portfolios, but for their freedom. Third, we hold builders and investors accountable. If a project markets itself as decentralized but relies on a few insiders or a centralized back end, that needs to be called out. If it sacrifices sovereignty for convenience, it should be questioned without a doubt. And finally, we remember why we're here. Crypto isn't about faster payments. It's about freedom. It's about building systems that don't require permission, that don't depend on trust, that give people ownership of their money, their data, and their future. Let me know in the comments. Do you see a difference between crypto and fintech? What's your favorite example of a project that sticks to the roots of decentralization? I love to hear your input on this. And if you want to dig deeper into these ideas, how money works, why self-custody matters, and how to navigate the crypto space with confidence, you got to check out learningcrypto.com. It's a resource that we've built specifically for people like you who want more than just price predictions. You want understanding. And that's what crypto is really about. Thanks for watching. I'll see you in the next video.